Hello, everyone, and thank you for joining me on this webinar titled Legally Reduce Your Cannabis Federal Tax Burden, where we'll untangle 280E and show you how to use Internal Revenue Code Section 471 to reduce your federal tax liability. I know very few people find taxes an interesting topic, but today's presentation will for sure give you some things to think about regarding not only reducing federal taxes and ensuring compliance, but making better business decisions and managing risk in this very turbulent industry. You don't need to be a tax expert to appreciate today's topic, and by no means will you be a tax expert after this next hour, but it's important that you implement strategies to actually reduce those taxes and improve your profitability and cash flow. Just one housekeeping item before we get started. Please use the chat box to record your Q&A questions, which I will go through at the end of this presentation. Just to introduce myself, my name is David Kay. I'm president of my company, Proactive Tax Planners, and we're located in Tampa, Florida. I'm a CPA, a certified management accountant, and a certified fraud examiner. I'm a Big Four alumnus. I have decades of experience in financial audit, internal audit, accounting, and tax planning, and I'm a 280E expert specializing in serving the cannabis industry. As I mentioned, I am a CPA, but not your CPA. So before we jump into the presentation, I must show you this disclaimer stating that this presentation is provided for educational and informational purposes only and should not be construed as tax advice. It's general guidance and might not apply to your individual circumstances, so you should not take any action based on this information without first consulting a qualified tax professional. Now that that's out of the way, let's jump into the meat of the presentation. We'll first talk a little bit about the cannabis industry and the new reality that we're in. We'll talk about the dreaded Internal Revenue Code Section 280E that's making your lives miserable. We'll talk about, however, Internal Revenue Code Section 471 that, if applied correctly and consistently, will mitigate the effects of 280E on your business. We'll talk about cost of goods sold, or COGS, which represents the cost of actually growing, manufacturing, extracting, or reselling your cannabis products. Since human resources and payroll is a large cost relating to your operations, we'll put some special focus on labor. We'll talk about mistakes that get cannabis businesses into trouble with the IRS. I'll give you some high-level questions to ask yourself to get a feel whether you may have some blind spots. We'll follow on with discussing a high-level roadmap to success. We'll talk a little about the bright side to all this, and believe it or not, there is a bright side. Then I'll have some final words and then time for Q&A. Since after the industry's green rush, we're now in the post-rush era that's characterized by mounting debt, tighter capital markets for cannabis, many operators running at a loss, falling flower prices, oversupply in some states, continued competition from the illicit market, start and stop bureaucratic and federal regulation delays, and the headlines aren't as rosy as they used to be. The lesson here is that those cannabis businesses still operating must elevate their performance even more to stay competitive, profitable, and creative to weather the storm and thrive. One way to do this is to put and keep more money in your pocket, and the way that I'm most familiar with is through saving on federal taxes. Whether you're growing, manufacturing, distributing, or a dispensary, there are always opportunities to save on federal taxes if you know what you're doing. I'll show you what you can deduct, what you cannot deduct, and how to avoid red flags that would alert the IRS. Let's talk about something that's causing a tremendous amount of heartburn in the cannabis industry, and that's 280E. 280E is a part of the U.S. tax code that was originally created in the 1980s to go after illegal drug traffickers. It basically says that if you're trafficking in a Schedule I or Schedule II controlled substance, you can't deduct your normal business expenses on your federal taxes. That means rent, salaries, marketing, utilities, gone, non-deductible. Now, fast forward to today, cannabis is still federally illegal, and it's still classified as a Schedule I substance. So even if you're a fully licensed, state legal cannabis operator, the IRS still sees you as a drug trafficker under federal law. However, you can still reduce your taxable income by your cost of goods sold or COGS, but you can't deduct any of the day-to-day operating expenses most businesses rely on to reduce their tax bill. This limitation creates an insanely high effective tax rate, sometimes 70% or more. And here's the kicker. This isn't just about taxes. It impacts everything from how you structure your chart of accounts to how you allocate labor and overhead to whether you can even stay solvent. The bottom line, 280E doesn't just hurt, it distorts your entire financial picture. Let's look at this side-by-side comparison just so you get the picture. Both businesses, one cannabis, one non-cannabis, bring in $5 million in gross receipts. Both have $2 million in cost of goods sold or COGS, which means they're each showing a gross profit of $3 million. So far, so good, identical top-line performance. Now, here's where it gets painful. Let's say each company has $1.5 million in operating expenses, things like payroll, rent, insurance, marketing, admin staff, legal, software, the works. These are normal expenses in any business. For the non-cannabis company, they get to deduct all $1.5 million from their gross profit, leaving them with taxable income of $1.5 million. They'll pay taxes on the $1.5 million. Now let's shift to the cannabis company on the right. Thanks to 280E, none of those SG&A expenses are deductible, not a single dollar. That company is stuck with its entire $3 million gross profit as taxable income. Same revenues, same COGS, same operating expenses, but the cannabis company is paying taxes on twice the income. So that's $3 million versus $1.5 million. And if you do the math with real-world tax rates, that could be a $300,000 to $600,000 bigger tax bill, even if both companies actually net the same amount in cash. That's not just unfair, that's operationally devastating. That's what's commonly referred to as paying taxes on phantom profits. It means cannabis companies are stuck in a constant uphill climb. They may be profitable on paper, but are still bleeding cash after taxes. It discourages investment in infrastructure, in people, in scaling responsibly, and it creates an environment where cutting corners looks tempting just to survive. That's why understanding and planning around 280E isn't just a tax strategy, it's a survival strategy. Now let's talk about a section of the tax code that can actually work in your favor. IRC Section 471. So what is it? 471 governs how businesses account for inventory and COGS. It tells you what costs can be included in inventory, how to track those costs, and how to recognize expenses over time as inventory is sold. Now, what does this mean for cannabis operators? Here's where it gets interesting. Because of 280E, you can't deduct most of your SG&A expenses, what we talked about before, but COGS is still able to reduce your gross receipts. So the more costs you can legitimately and consistently move into inventory and then COGS, the better your tax outcome. 471 gives you the rules and the boundaries for doing this. So if you're a cultivator or manufacturer, full absorption costing under 471 lets you include direct labor, certain overhead, and even some indirect costs in inventory. That reduces taxable income when that inventory is eventually sold. Think of it like this. 280E shuts the front door, but 471 opens a side door, and if you walk through the side door the right way, you can significantly reduce your tax burden. But, and this is important, this isn't a loophole or a free-for-all. The IRS expects you to use a defensible costing method, keep detailed records, be consistent from year to year, back up your allocations with logic such as time studies or square footage or batch reports, and done correctly, 471 is one of the few tools cannabis businesses have to stay compliant and competitive. So while 280E hurts, 471 offers a way to fight back strategically, legally, and defensively. Let's walk through this list of raw materials and supplies together, because understanding what's eligible for inventory and COGS can make a huge difference in your tax bill. Under 471, you're allowed to include materials and supplies that are either an integral part of the final product or consumed in the production process and traceable to specific units. Here are some great examples. So you've got seeds, clones, and tissue cultures. These are the beginning of your product. Biomass like fresh frozen, dried flour, and trim. These are your raw materials for processing, especially for manufacturers making concentrates or extracts. Grow media such as soil, cocoa coir, and rockwool. These support the plant's development and are consumed during cultivation. Solvents like ethanol, butane, propane, and CO2. Filtration media like activated carbon and silica. Cartridges, syringes, jars, tamper seals. These are packaging components that become part of the finished product. Water, if it's used specifically in production. Dry ice and liquid nitrogen. Filter papers or membranes. Nutrients and fertilizers. Pots, trays, and containers. These house the plants during their life cycle. And you've got stakes and ties that are used to train or support the plant during growth. Gloves and pruning shears. Well, they seem minor. If they're single use or batch specific, they're consumable and part of production. You've got packaging wraps and bags. If they leave the facility with the product, they're part of the final deliverable and definitely COGS. Now, here's the key. All of these must be used directly in production, and you need a system to track them by batch, by room, by lot, something that makes the IRS say, okay, that's reasonable. So the takeaway here is good cost tracking turns tax pain into tax savings, and these raw materials and supplies are your starting point. Now let's talk about people, because labor is often one of the biggest costs in a cannabis operation. If an employee's time is spent directly touching the product during cultivation, processing, or packaging, that labor can often be included in inventory and eventually deducted as COGS. Here's some common direct labor roles. So, cultivation specialist, they're hands-on in the cultivation room. They're planting, watering, monitoring pH, adjusting lights, pruning. If they're nurturing the plant, they're COGS. You've got your harvest team. So once the plant is ready, someone has to harvest, hang dry, and trim it. These activities are all part of production and are traceable to specific batches. So extraction and lab personnel. Think of chemists, lab assistants, QA testers. If someone is operating the extraction machine, recovering solvents, purifying oils, or doing compliance testing, that's production. You've got your primary packaging staff. So if someone is filling jars, pouches, or cartridges with finished product, before any branding or marketing is applied, that's COGS. We're talking about physically getting product into the container that leaves your facility. And then you've got your support roles that touch production. This is where it gets interesting. Some support employees can be partially allocated if they work in service production. So for example, someone doing seed to sale data entry for batches in cultivation or extraction, a quality assurance employee who inspects batches before packaging, inventory control staff managing movement of raw materials or finished goods. Now, here's the key. It's not about job titles. It's about job functions. If someone's daily work involves touching the plant, product, or process, they likely belong in your inventory pool. So to do this right, cannabis operators should track labor time by department, room, or batch, use time studies or time and attendance logs, and document allocation percentages and revisit them regularly. And why is this so? Because every hour someone spends touching the product is an hour you can potentially deduct when 280E would otherwise disallow it. So labor isn't just a cost, it's also an opportunity if you know how to handle it. Now let's talk about indirect labor. These are the folks who aren't directly trimming buds or operating extraction machines, but they still play a critical role in the production process. These employees are often overlooked when calculating COGS, but if you apply absorption costing under 471, their wages may be partially allocated inventory. So let's walk through some examples. So you've got production management. They may not be doing the pruning or packaging themselves, but they're supervising the team that does. If they're overseeing production, they're contributing to the process, and their time may be allocated proportionally to COGS. You've got your maintenance and repair technicians. So when your lights, HVAC, extraction rigs, or automated trimmers break down, who keeps those things moving? It's the maintenance staff. If they're focused on the production areas like the grow rooms, extraction labs, packaging lines, they can be allocated to overhead and included in inventory. Security staff, this one surprises people. If you're in a state that requires cameras, guards, or restricted access for grow or processing zones, your security costs may be required for compliance. You can allocate their wages based on how much time they spend protecting production versus retail. You've got your quality control and testing staff. If their job is to monitor moisture content, cannabinoid levels, or contamination before product goes to the market, they're protecting your product's value. That's a production related function, especially for cultivators and extractors. Janitors and sanitation. If they're cleaning production areas such as grow tents, trim rooms, packaging, clean rooms, they're supporting the production environment. As long as they're not cleaning retail space, this labor can be a COGS contributor. Facility ops and utility staff. These are the people managing power systems, waste disposal, nutrient water systems, and climate control. Your HVAC people keep your yields alive, and their work directly supports cultivation, which makes them eligible for partial allocation. Now, here's the key to doing this right. Again, you need a reasonable allocation method, which could be time-based logs, square footage used for production, equipment logs or maintenance schedules, payroll cost centers tied to functional departments, and you need documentation to back it all up. So the bottom line, these indirect labor roles are often the difference between a 50% and a 30% effective tax rate if you can show the IRS how they support production. So don't ignore these roles. They may not touch the plant, but they absolutely touch your bottom line. All right, so we've talked about which roles qualify for COGS treatment, but now let's zoom in on how you calculate the labor costs themselves, because it's not just hourly wages or base salaries. You can include a whole lot more as long as these costs are tied to qualifying labor. So here's what we mean. First, gross compensation. This is your starting point. It's the total compensation you pay to employees directly or indirectly involved in production. That's fully includable if the job function qualifies. Overtime. For example, if an employee is working a double shift to finish a harvest or complete a processing run, that extra compensation is production related and should absolutely be included in COGS. Now, bonuses. Bonuses can be tricky, but if the bonus is tied to production performance, like output volume, efficiency, quality control benchmarks, then it can be part of inventory cost. However, discretionary bonuses or ones tied to company-wide financial results most likely are excludable from COGS. Then you've got your paid time off, which is sick time, vacation time, personal days. Here's one that gets overlooked. If an employee is normally working in a COGS eligible role, say packaging tech, and they take a paid sick day, that time is still considered part of their labor cost and can be allocated to COGS based on their normal function. Then you've got employer paid payroll taxes such as FICA, FUTA, SUTA. These are all costs you incur as an employer to keep someone on payroll. If their work is production related, these taxes are directly tied to labor costs and should be treated as COGS. Then you've got employer provided benefits, so health insurance, dental, vision, even life insurance or HSA contributions. These are real employment costs. When the employee's time qualifies as COGS, so do these fringe benefits. Workers' compensation. This is mandatory in most states and tied to job function. If you're paying workers comp on your trim team, extraction techs, or grow room staff, those premiums are a cost of labor and can be proportionally treated as COGS. We've got some other employer costs that may be included, but these are often overlooked, such as uniforms or production-specific clothing, safety gear and PPE, training costs for production roles, production software licenses, temp labor agency fees. But again, here's the key. The test isn't whether the cost exists, it's whether the cost supports production. And then, are you tracking it? Can you back it up with logic? Do you apply it consistently year to year? This is where a good cost accountant can help you turn a high tax bill into a manageable one by capturing these opportunities the right way. And remember, when done right, this isn't aggressive. This is how other manufacturers handle their books every single day. We're just finally applying it to cannabis. Just to illustrate how important it is to include all labor-related COGS that could reduce your tax burden, let's take this example for a cultivation technician with an assumed base salary of $45,000. If you load on the FICA, FUTA, SUTA, health insurance, workers' comp, and some PTO and sick time, you have an additional $16,123 that qualifies as inventoriable for COGS. That's almost an additional 40% compared to base salary. That $45,000 a year cultivation tech is really costing you at least $61,123. So the question is, how much money might still be on the table? We've talked a lot about the people whose wages and benefits can be included in inventory under 471 and eventually deducted as COGS, but now let's shift gears and talk about the other side of the fence, those folks you cannot deduct no matter how critical they are to running your business. These are the roles that are not directly or indirectly involved in production. Even if you pay them well, even if they work long hours, the IRS says, sorry, not deductible under 280E. Let's walk through some of the most common non-COGS roles. So first one, sales, marketing, and advertising staff. You might love your social media coordinator, your brand ambassador, or your retail sales team, but none of their wages are includable in inventory. 280E makes all sales and marketing expenses completely non-deductible. Then you've got your distribution team. So delivery drivers, logistics coordinators, warehouse staff handling outbound shipments, and route managers. Once the product is manufactured and ready for sale, any labor related to getting it to customers is a selling expense, not a production cost. Then you've got your R&D staff. Now this one trips up a lot of operators. If you have a chemist doing new product formulation, that's research, not production. Think edibles development or terpene profile testing for future strains. These are forward-looking and not part of COGS. Then you've got your corporate leadership and back office, which includes your CEO, your COO, or CFO. If they're running the entire business, not specifically managing production, they're disqualified. The same goes for in-house legal counsel or finance directors not tied to operations. You've got your administrative support, which includes admin assistants, receptionists, office managers, and employee relations staff. Even if they're helping the grow manager schedule meetings or file paperwork, they're considered general and administrative, and they're fully disallowed. Then you've got your HR folks. So this includes your HR managers, recruiters, benefits administrators, and employee relations staff. HR plays a huge role in hiring, compliance, and employee relations, but they really work across the company, not specifically in production. Their wages aren't deductible. Then you've got your IT staff. This includes your network administrators, software developers, help desk personnel, and others. If your IT team supports the whole business from the dispensary POS systems to internal servers, they're not tied to inventory, so they're disqualified. Your retail staff. Now, this is a big one. Your dispensary staff may handle a high volume of sales, but once the product is packaged and on the shelf, it's considered post-production retail. That means no COGS treatment for their wages or related costs. Other examples you might miss would be compliance officers, company event planners or PR reps, internal training staff for sales onboarding. Unfortunately, the IRS draws a hard line here. Only costs that get the product ready for sale can be included in COGS. Everything that happens after that or serves the business as a whole is out. So the lesson is don't overreach. If you try to include everything, you risk an audit, and a disallowed deduction could trigger penalties, interest, and even bigger 280E tax bill. So be strategic, be compliant, and most of all, be defensible. Payroll in cannabis is one of the riskiest areas of compliance, and if you don't take it seriously, it can land you in deep water fast. The reason why is the cannabis industry already operates under a microscope. You're dealing with federal scrutiny, state level licensing, banking limitations, and tax nightmares like 280E. Now stack labor law violations on top of that, and you've got a powder keg. Let's walk through some of these risks here. So, first, wage theft claims. If you don't properly track hours, pay overtime, or distinguish between exempt versus non exempt roles, employees can and will file claims. It doesn't matter if you're paying in cash, crypto, or Venmo, it all has to be compliant. One claim can open the floodgates. State labor penalties. Every state that has its own labor laws, and cannabis regulators are watching these closely. Issues like missed breaks, lack of sick leave accrual, or failure to post wage notices can lead to hefty fines. Then you've got IRS audits. So improper tax withholdings or misclassified employees, or if you've got inaccurate time tracking tied to COGS, that's a red flag to the IRS. And once they start poking around, they usually don't stop at payroll. Then you've got federal investigations, and here's the big one, cash handling. If you're paying employees in cash without airtight tracking, you're setting yourself up for federal scrutiny. It can trigger investigations around wage theft, tax evasion, even potential money laundering allegations. So the bottom line is this. Payroll and time tracking aren't back office chores. They're compliance critical. And if you're using those numbers to build your COGS allocations under 471, then your time logs are not only about employee rights, they're the foundation of your tax defense strategy. Now that we've talked about the risks of payroll non-compliance, let's shift to what doing it right actually looks like. Running payroll in cannabis is not like running payroll in any other industry. You can't just plug into QuickBooks and call it a day. You've got to be strategic and you've got to cover your bases. So the first recommendation is use a state compliant payroll provider. Not every payroll company wants to touch cannabis. Some will say yes until their bank says no. You need to partner with a provider that understands 280E, 471, cash heavy operations, and your state's cannabis employment laws. They'll help you avoid compliance gaps before they become audit triggers. Set up direct deposit through a cannabis-friendly bank or credit union. It's still tough out there with federal banking restrictions, but more local banks and credit unions are stepping up. If you can, set up direct deposit. It's clean, traceable, and minimizes your exposure to cash risks. But if direct deposit isn't possible, use physical checks with full backup. So if you're cutting paper checks, make sure each one is tied to a legit payroll register with withholding calculated, pay stubs issued, and copies stored. Never hand someone a check from your personal account and hope for the best. If you make on-premise cash payments, you better have full documentation. Sometimes you're stuck with cash, that's reality, but that doesn't mean you're off the hook. You still need time cards or clock in, clock out logs, pay stubs showing gross pay, taxes, and net, employee signatures or receipts confirming payment, and please do not pay under the table. The IRS calls that constructive fraud. You've got payroll debit cards, also known as prepaid payroll cards. This is a growing workaround. You can load employee wages onto prepaid cards that function like debit cards. Just make sure the provider is cannabis compliant and you're still issuing stubs, handling taxes, and reporting everything properly. And we talked about this before, but classify workers correctly. There are no shortcuts here. This one's huge. Do not misclassify your workers. Just because someone says, I'm a contractor, or you simply want to issue a 1099, doesn't make it legal. If the person works under your control, uses your equipment, and follows your schedule, they're an employee, period. So the bottom line is, you need your payroll records to be bulletproof. Because when the IRS shows up, or your state's labor board, they're going to ask who got paid, how, for what, and where's the paper trail. If you can't respond to these inquiries, you're not compliant. If you can answer these questions, you've just earned yourself a layer of audit protection and possibly a sizable tax deduction as well. Let's talk about overhead. Overhead is one of the biggest hidden opportunities in cost accounting for cannabis operators. Under 471, if your overhead costs are tied to the production of inventory, they can be allocated into COGS. That includes both fixed costs like rent and depreciation and variable costs like utilities and supplies. So some examples of facility costs are like rent. So if you lease a building or grow facility, you can allocate a portion of that rent to COGS based on how much of the space is used for production. You'll want to do a square footage calculation so that you're not guessing at the square footage. Property taxes, same idea as rent. If you're paying property tax on a facility, a portion of that tax tied to cultivation, extraction, or packaging space can be included in inventory cost. Also, certain insurance policies. So if you have insurance for production equipment, property insurance for the production area, those could be includable. However, general liability or key man insurance for your CEO is not part of COGS. You've got your production support folks. So we're talking about on-site facility managers, production controllers, or operations supervisors whose work is dedicated to keeping the grow, lab, or packaging line moving. Their salaries may be partially included in COGS as indirect labor. Then you've got indirect materials. These are materials that you don't necessarily track per batch, but they're still used up in production, such as lubricants for equipment, cleaning agents for machines or tools, light bulbs for grow rooms, shop towels or PPE. Basically, if it gets used behind the scenes to keep production running, it counts as COGS. Then you've got utilities, such as electricity for your grow lights, water for cultivation, gas for extraction equipment, even trash service for the production areas. If the utility supports production, it's eligible for COGS. Then you've got repair and maintenance. So this includes routine upkeep on your extraction equipment, packaging machines, irrigation systems, or HVAC. Again, the key is they must relate to the production environment, not your dispensary showroom. Then you've got depreciation. This is a big one. If you've invested in grow lights, HVAC systems, extraction rigs, trimming machines, racking, or tables for cultivation, you can depreciate those costs over time. And if they're used for production, that depreciation gets absorbed into inventory and reduces taxable income. So the takeaway regarding overhead. So although you want to keep your overhead expenses lean, overhead is not the enemy when it comes to COGS. It's a huge part of compliant cost accounting, but you've got to link cost to production, be methodical, use reasonable allocation percentages, keep good records, and be consistent year after year. Because if you do it right, you're not just compliant, you're also keeping more of your hard-earned dollars, and that's the name of the game in this industry. Let's talk now about dispensaries, because when it comes to 280E, they're the ones who get hit the hardest. Why? Because dispensaries don't produce anything, they just resell cannabis products. And under IRC 471-3, the IRS limits what retailers can include in COGS. So here's the breakdown. So what's includable in COGS? So you've got your purchase price. This is the price that you pay when you buy product from a licensed grower, manufacturer, or distributor. So if you paid $1,800 for a pound of flour, that's your base COGS. Then you have to reduce COGS by any trade discounts. So if you received a bulk discount or early pay credit, this amount actually reduces your COGS. The IRS wants to see net pricing. Then you've got transportation and acquisition costs. This is where there's a small silver lining. So freight or delivery charges from a vendor to your store is includable in COGS. Also, insurance costs on those shipments are includable in COGS, and even import duties or tariffs in dual license markets are potentially includable in COGS. Then you've got certain storage costs. So if you had to store that inventory off-site before it could be legally sold, like in a licensed warehouse, for example, that may be treated as part of acquisition, but it has to be required, not optional. And if you run a hybrid operation where your dispensary is also a cultivator or manufacturer, say you grow and sell in the same entity, you may be able to use IRC 471-11, which allows what we mentioned before, full absorption costing. So that opens the door to allocating things like we talked about before, indirect labor, depreciation, overhead, and more. And this is critical, you can only apply that to your production activity. You still cannot use 471-11 to shift general retail costs into COGS. If it's tied to the retail sale, it's off limits. For dispensaries now, what cannot be included? Anything that's considered a general overhead or administrative expenses. So what does this mean? So no rent for your showroom, no salaries for your cashiers, bud tenders, or store manager, no utilities, no office supplies, no branding or marketing. And here's the warning. If you try to get creative and dump overhead into COGS, especially without documentation, you're asking for an audit. And the IRS has zero patience for dispensaries that push the envelope on 280E. The bottom line, dispensaries live in the most restricted part of the cannabis tax world, but there's still value in understanding what is allowed to be considered COGS, documenting it tightly, and not stepping over the line. If you can do that, you might not love 280E, but at least you'll survive it. It's not enough to know something should be deductible, you have to prove that it is. The IRS isn't going to just take your word for it. If you want to include payroll, overhead, or indirect costs and COGS under 471, you've got to back it up with real documentation that shows what people were doing, when they were doing it, and how it ties to production. So you really need to document job descriptions. You've got to clearly define who does what. If a grow tech handles pruning, irrigation, and pest monitoring, that needs to be reflected in their job description. If someone moves into a packaging role or gets promoted to shift lead, update the documentation. This is your foundation for labor classifications. You also have to record labor accurately. An automated time attendance system isn't just a productivity tool, it's an audit defense tool. But you have to make sure that you're logging clock ins and clock outs, breaks and meal periods, overtime hours, task codes or job functions, whether the worker is exempt or non-exempt, and where possible, document plant tasking assignments such as trimming room A or harvesting batch 1, 2, 3. This level of detail makes it hard for the IRS to challenge your labor allocations. Also, you've got to ensure that tasks trace to production. We mentioned this before, but let's say you've got an employee cleaning grow trays and another one transferring extracted oil into cartridges. Those activities need to tie back to the inventory being produced. That's how you justified labor as inventoriable. Also, use reasonable allocation methods and document them. You don't need perfection, but you do need logic. And you should be updating your allocations when operations change. The cannabis industry evolves fast. So if your team is cross-trained and they are wearing multiple hats, say trimming in the morning and packaging in the afternoon, you'll need to adjust your cost allocations to reflect that reality. And the same goes for if new automation or equipment are introduced, promotions that move employees out of direct labor, production volume changes that shift fixed cost percentages. The bottom line is this isn't a one-time setup. It's a living system that evolves with your operations, and the better you track it, the better chance you have of reducing your 280E exposure and surviving an audit. If it can't be tracked, it can't be deducted. This is where we shift from strategy to warning signs, and I want to be clear here. If you play games with your entity structure or EINs, you're putting a target on your back. Yes, cannabis operators face brutal tax burdens under 280E, and yes, it's tempting to look for workarounds. But there's a big difference between smart planning and aggressive structuring that crosses the line. Let's go through what not to do. So firstly, don't use multiple EINs to artificially split the business. Some operators try to create multiple entities like one for cultivation, one for sales, one for management, and then claim deductions in the non-cannabis entities. But if the IRS sees these as functionally one business, they'll collapse the entire structure and apply 280E to the whole thing. So that's one thing you definitely want to be careful of. Two, don't fresh start with a new EIN to avoid audit history. So if you close down a company with tax or compliance issues and start a new one with a clean EIN, but you have the same owners, same location, same operations, that's a red flag. The IRS has tools to trace continuity, and you might just invite a retroactive audit. Don't use a management company as a 280E workaround. This one's common. So operators form a separate management company, and I put quotations in that, and try to pay it for admin, HR, and marketing, hoping that entity can deduct those costs. But if that company is effectively controlled by the same owners and is serving only the cannabis business, the IRS may treat it as a sham and apply 280E anyway. And don't misallocate revenue or expenses across entities. Be careful not to push revenue into the quote unquote clean entity or dump all your expenses into the non-plan touching side. That's considered misrepresentation. And even if you think you're being strategic, it can lead to disallowed deductions, penalties, and potential fraud allegations. So the better play is understand the rules, document everything, use legal, well-supported strategies under IRC 471, not shadow structures. And the bottom line is, don't outsmart yourself trying to outsmart the IRS. If you're unsure whether your entity structure would hold up in an audit, get a second opinion. It's because it's a lot easier to fix it now than to defend it later. Now, this next topic is a big one, and it's where a lot of cannabis operators get tripped up. We're talking about losses, specifically shrinkage, theft, spoilage, and inventory write-downs. Here's the key thing to understand. Just because you lost product doesn't mean it reduces your tax bill, because under 471, most losses cannot be written off as COGS unless they meet very narrow criteria. And if you try to push these costs through COGS incorrectly, you're not just risking disallowance, you're flirting with IRS scrutiny for possible diversion. Let's walk through these losses. So, theft or physical loss disallowed. So if inventory disappears and you can't explain it, or you report it as stolen, the IRS assumes the worst, that it might have been diverted into the illicit market. It doesn't matter if it was internal theft, break-in, or sloppy tracking, it's not deductible. Obsolescence or abnormal spoilage is disallowed as well. If your product expired on the shelf, got moldy from poor humidity control, or dried out due to bad packaging, it's considered avoidable, and the IRS treats that as a business operations failure, not as a deductible loss. If you have abnormal mold loss, disallowed. And here's a real example. So if your flower molded because you never installed dehumidifiers or your dry room was out of spec, that's on you. The IRS calls that abnormal spoilage, and you can't push it through COGS. But here's the good news. Normal spoilage can be deducted if you do it right. So here's what it looks like. So if the spoilage occurs as part of the normal production process, and you can reasonably estimate it, say that's maybe 4% moisture loss during curing, and you can track it consistently by batch or stage, you apply it to the remaining goods and units, not as a lump sum write-off. It's not due to avoidable errors or poor SOPs, then that normal spoilage can be included in COGS. And normal spoilage includes things, evaporation loss during extraction, normal mold loss during drying or curing, even in a clean room, a few units lost during compliant packaging or transfer. Those would be considered normal. But here's your best defense. Bake a certain amount of normal spoilage into your yield estimates. That way it becomes a built-in cost, not a surprise adjustments, but you have to have robust destruction verification SOPs as well. So every time you destroy a product due to mold, breakage, failed testing, you need full documentation. For example, a batch ID, weight destroyed, reason for destruction, sign-offs and timestamps, a photo or video if required by your regulator. And the reason is because when the IRS audits you, they're not just looking at numbers, they're looking at how you got those numbers. So be accurate, be honest, and don't assume you can write off every lost gram. If it's normal, you may get relief. If it's avoidable, though, you're out of luck and maybe in hot water. This is where everything we've been talking about comes full circle. When it comes to COGS and 471, there are two types of mistakes cannabis operators tend to make. The first mistake is leaving money on the table. You play it too safe. You don't include everything that's legally allowed in COGS because you're not confident or your accountant isn't experienced with cannabis. So the risk is that you wind up paying way more in federal income tax than you should. You're losing cash, not because your business is unprofitable, but because your costs are underreported. And that's like handing the IRS an extra check every quarter for no reason. And the second mistake is, on the other hand, getting too aggressive. So the other side is that you're treating too many expenses as deductible through COGS. Maybe it's you put in there cashier wages or sales staff or retail rent. And the risk is that now you've got the IRS on your back. You could be facing tax adjustments, back taxes, penalties, even audit flags for possible fraud if it looks intentional. And it doesn't stop there, what I call garbage in and garbage out. If your cost allocations are off, where you're perhaps mixing allowed and disallowed expenses, you're also messing up your internal numbers. You're skewing your profit analysis by strain or SKU. Your cash flow projections are inaccurate. Your pricing decisions are based on bad data. Really, in other words, your books might look good on paper, but they're telling you the wrong story. So the bottom line, you can't afford to be too cautious or too aggressive. You've got to be accurate, consistent, and defensible. That's how you protect your margins, stay compliant, and make good business decisions made on real numbers. This is one of the most important parts in the presentation. Why? Because if you can't confidently answer yes to most of these questions, then you've got blind spots. Blind spots that could cost you money, trigger an audit, or leave you flying blind on profitability. Let's walk through some of these. So, do I have an SOP for my accounting, labor recording, and inventory costing? If your processes aren't written down, standardized, and followed, you're winging it. That's risky when it comes to audits or consistency. Is my chart of accounts appropriate for my business? Generic chart of accounts through QuickBooks won't cut it. You need a structure that distinguishes costs by department, production stage, and tax treatment. Do I have just one inventory bucket? If everything is dumped into inventory and you're not breaking it out by raw materials, WIP, and finished goods, you're losing visibility and accuracy. Am I cycle counting inventory at least monthly? Is it accurate? You don't need to do a full cycle count every week, but if you're not doing regular rotating cycle counts, you're guessing on your inventory value. Do I have adequate controls over the track and trace system? Anyone adjusting metric or biotrack without documentation, that's an audit nightmare. So you need to build controls and review logs regularly. Can I track profitability by each strain or SKU? You should know which strains are moneymakers and which ones are just pretty pictures on Instagram. Without a product level P&L statement, you're not managing, you're reacting. How confident am I in my yields? If your expected yield is off by 10 to 15% every month, it's not a bad month. It's a system problem, either in cultivation, processing, or measurement. Am I accounting for all weight losses or changes? Whether it's evaporation, trimming, pressing, or packaging, every gram should be accounted for. Losses need to be explained and not assumed. Do lab results match what I expected? If your THC percentages or moisture levels are consistently off, it could be a production issue or a sign of bad data entry or product switching. Can I project cash flows for at least 12 months out? You can't operate on vibes. You need a forward-looking cash model that accounts for seasonality, tax payments, and capital needs. How confident am I in tracking all biomass? That includes fresh frozen, trim, failed test lots, and extracts in progress. Biomass is where inventory tracking either shines or falls apart. Does my flowering schedule align with what was produced? If your production calendar says a harvest is coming and it doesn't show up in inventory, that's a problem. Red flag. Is there a lot of unexplained shrink, what we talked about before? So shrinkage isn't just a number, it's a red flag. If you can't trace where product went, the IRS might assume the worst, diversion. Are my cash controls sufficient? Cash drawers, vault access, armored transport logs, this is not optional. If your business touches cash, treat it like Fort Knox. Am I filing IRS Form 8300 for all cash receipts over $10,000? This is low-hanging fruit for the IRS. And if you're accepting large cash payments and not filing Form 8300, you're lighting a fire under your own feet. So the bottom line is, if you answered no or I'm not sure to at least 1/3 of these, don't panic, but get help now, because every no is a vulnerability that can impact your profitability, your compliance, and your ability to scale. All right, so now that you've seen all the risks, the opportunities, the tax traps, and the compliance best practices, what's next? Whether you're a cultivator, manufacturer, extractor, or dispensary, if you want to protect your profits, stay IRS compliant, and make smart operational decisions, here's where you start. So step one, perform a self-diagnostic. Take a hard look at your current systems, pull up that checklist from earlier and those questions we went through, and answer every question honestly. What are you tracking well? What are the gaps? If you don't know where the holes are, you can't patch them. So step two, segregate cost categories properly. You can't just lump everything into inventory or COGS and hope it passes. You need to separate direct labor, indirect labor, overhead, SG&A, marketing. The IRS will want to know exactly what's being included and why. Step three, reorganize your chart of accounts. If your chart of accounts hasn't been touched since the day you opened your bank account, it's probably time for a change. You need categories that reflect cannabis-specific functions like cultivation stages, extraction activities, packaging, 280E disallowed costs. So just make sure that your books are working for you, not against you. Step four, perform time studies or upgrade timekeeping. If you want to allocate labor costs to COGS, you need evidence. I know I've said this many times before. You need to track employee time by strain, task, room, or department. If time studies are too much, tighten your timekeeping system so it can do the job. Step five, recalculate and support cost allocations. You're likely underallocating or worse, over-allocating without backup. So run the numbers again, use reasonable allocation methods, and document everything. Step six, clean up your financial records. This is more than just reconciling your bank account. It means cleaning up old entries, removing miscellaneous dumping grounds, and making sure inventory balances, yields, and depreciation are actually accurate. Step seven, strengthen your cycle counts. Don't wait for year end to find out that you're off by 30 pounds of flour. Put monthly or rolling cycle counts into place with SOPs, variance reviews, and sign-offs. Step 8, implement cash controls and IRS Form 8300 compliance. Cash-based operations need vault procedures, dual sign-offs, daily reconciliation, and clean paper trails. Don't forget, every cash receipt over $10,000 requires IRS Form 8300 to be filed. That's a federal requirement. Step 9, then recalculate your 280E tax impact. Once your allocations are cleaned and your records are updated, run a fresh tax model. What's your new federal tax liability under 280E? What can you do to reduce it legally, defensively, and strategically? Bottom line, this roadmap isn't just about staying out of trouble, it's about running a smarter business. If you follow these steps, you will not only survive, but you'll be able to make better decisions every single day. There's been a lot of talk over the years, and even as recently as Trump, signaling a possible rescheduling of cannabis. Though rescheduling will absolutely provide much relief to the industry, it's by no means a magic bullet. Even if cannabis is rescheduled, this is not a get out of jail free card. Actually, most things, at least from a cost accounting perspective, will not change. So you still need to maintain proper cost accounting. Understanding your true production costs isn't just about taxes, it's about profitability, price strategy, and competitive positioning. You'll still need to properly value inventory. 471 requirements for inventory accounting don't disappear with rescheduling. Proper inventory valuation remains mandatory for GAAP compliance, lender requirements, and accurate financial reporting. You'll still need to run profitably. Tax liabilities are irrelevant if your business isn't generating sustainable profits. Rescheduling doesn't solve fundamental business challenges like overcapacity, pricing pressure, and operational efficiency. And of course, you still have to maintain good margins. So understanding your true costs enables you to maintain healthy margins and make intelligent pricing decisions. Businesses that don't know their costs make poor pricing decisions regardless of tax treatment. And you still need to gain investor confidence. Investors and lenders demand clean books, accurate cost accounting, and transparent financial reporting. Rescheduling won't change these requirements. If anything, professional investors' expectations will increase as cannabis becomes more mainstream. State level excise taxes will mostly not go away with federal rescheduling because many states depend on cannabis tax revenue for budget commitments. Your state tax compliance burden continues regardless of federal rescheduling. And 280E most likely will not be repealed retroactively. So your 2024, 2023, 2022 tax years will most likely have to comply with 280E. Outstanding tax liabilities from prior years remain due, and audit exposure for those years continues. All right, we've covered a lot today, and it might feel overwhelming, but here's the bright side, and I mean that sincerely. If you do this right, you're not just surviving, you're pulling ahead. So let's reframe this whole conversation. So look at compliance equals competitive advantage. Most operators, let's be honest, are flying blind. Their books are a mess, their costs are guesswork, and their tax liability is way higher than it needs to be. So if you're the operator who gets this right, you're not just compliant, you're ahead of the pack. Again, I keep saying this, but understand your true production costs. When you know exactly what it costs to grow or make your product, by strain, by batch, by SKU, you can finally stop pricing on gut feel and start pricing for profit. You'll know which products are worth scaling and which ones are actually dragging you down. You'll be able to set profitable prices. So when you understand your inputs, yields, and conversion costs, you're not chasing the market, you're actually defining it. You can price with intention and not guesswork. That's how you protect your margins. And you can impress investors and buyers. So if you want funding, if you want a successful exit, your numbers have to be tight. A clean P&L, real cost tracking, inventory controls, compliance procedures, those things that make you look buttoned up, professional, and acquisition ready. And in fact, this kind of operational discipline is one of the first things that buyers and investors are asking about. And you'll be able to make better business decisions. At the end of the day, this is about visibility. Good compliance gives you good data, and good data lets you make smart, confident decisions about scaling or pricing, cash flow, staffing, a lot more. So don't see this just as tax talk, This is a roadmap to profitability and peace of mind. The cannabis industry is tough, but if you can embrace compliance as a strategy and not see it as a burden, you're building something resilient, scalable, and valuable. Wrapping up now with some final words and lessons learned. 280E presents challenges, but 471 provides opportunities. And the businesses that master this balance don't just survive, they thrive while their less sophisticated competitors struggle. Remember that COGS is king in cannabis taxation. Include everything in COGS that you're legitimately allowed to include. Leave no dollar on the table that belongs in your inventory cost basis. So keep excellent records that support every allocation, every cost classification, every material transaction. Documentation is your only defense during an audit. See compliance as strategic, not just defensive. The financial infrastructure you build for tax compliance enables better decision making across every aspect of your business. And just do realize that you have more control over your tax outcome than you might believe, but you must know what you're doing. Expertise and proper guidance make the difference between overpaying and optimizing. Don't get overly aggressive and cross the line into unsupportable positions because the penalties for aggressive tax schemes far outweigh any temporary savings. Stay within defensible boundaries. Ask the right questions to get honest answers. Challenge assumptions, verify data, don't accept. That's how we always have done it as justification for questionable practices, and position yourself for tomorrow's challenges and opportunities. Whether cannabis is rescheduled or remains Schedule 1, businesses with professional financial operations will win, so that build that foundation today. Okay, so we've covered a tremendous amount today, and now it's time for Q&A. I see I'm running up close to the hour anyway, so there's a couple of questions that folks put in. I'll try to go through a couple of them. First one, do you find that most companies are using the cash basis of accounting or the accrual basis of accounting? Really, as a rule of thumb, like the large publicly held MSOs like Curaleaf and Trulieve and Verano, they have to use accrual basis of accounting. And I suspect that large private MSOs do the same. Smaller operators probably use the cash basis of accounting, but the fact is that really for the benefits of 471 to be realized, and since cannabis operators maintain inventories, they must use the accrual basis of accounting, not to mention the inherent limitations of using a cash basis of accounting. The final analysis is that the accrual method is the standard and safest method for cannabis companies. Next question, we're using metric, but I don't feel confident our inventory is accurate. Where do we start? Well, where you always start is start with your physical counts. Like we mentioned before, if your cycle counts aren't being done at least monthly and reconciled back to your seed to sales system, whether it be metric or BioTrack, you won't catch variances early. And most importantly, standardize your SOPs for how data gets entered, adjusted, and validated across departments. As I mentioned in that self-diagnostic, you should be reconciling your seed to sales system back to your financial systems and vice versa. So again, start with your physical counts, see if they're lining up with metric in this case, and find out why they might not be lining up. Third question, we've experienced some mold issues. How do we document spoilage properly so that it's considered normal? Well, normal mold or fungus, for example, could be a minor powdery mildew on lower leaves or some slight bud rot or some minor post-harvest loss during drying or curing. That's inherent and recurring in the cultivation process and easily predictable during normal grow conditions. Normal spoilage needs to be reasonably estimated, consistently tracked, and tied to your expected yields per strain or product type. You should start by building yield expectations and include a spoilage factor allowance in your cost model. I don't care if it's 1% or 5%. You've got to build in something that you can historically demonstrate. And really outside of that range, anything outside, especially due to equipment failure or poor storage or an outbreak, that will likely be considered abnormal and non-deductible. And of course, don't forget, all destruction events should be thoroughly documented in your SOP. Is it okay to use a management company to handle things like marketing or admin as long as we don't try to deduct those expenses under a cannabis? So it's a gray area, and the IRS watches it closely. If the management company is truly separate, performs non-plan touching services, and doesn't shift costs back into your license and these COGS, it may be permissible. But if its structure is designed solely to avoid 280E or disguise expenses, it can be challenged. So I always say transparency is the best way, and clean separation of the functions, your books and cash flow, it's critical. So now that we're running over, I'll wrap up here. Thank you all again for your time and attention. And if you have any further questions, please don't hesitate to contact me either on LinkedIn, or you can email me at david@proactivetaxplanners.com. A replay of this webinar will be sent to all who registered for it. Take care and enjoy the rest of your day.